Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 11th March 2022, and joining Derek to pose some questions on the financial market themes for the week ahead is Chris de Sibert, Head of Institutional Investors FX Sales for EMEA. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Good afternoon, Derek.
Good afternoon, Chris.
Well, listen, the financial markets are still very much focused on the terrible developments in Ukraine. G10 FX performance shows euro was in fact the second best performing currency this week. What is behind that, and does this signal better times ahead over the coming weeks?
Yeah, it's been another volatile week for sure. I think first of all, you highlight a good point. In fact, Swedish Krona was the best performing, and then euro was the second best, and then last week it was the complete opposite. The Swedish Krona was the worst performing, and the euro was the second worst performing. So clearly, the events last week compared to this week there's a sense of the really bad situation a week ago is not as obvious. And I've said before that there are a number of different contagion channels that could reverberate through Europe. And the most obvious is through the energy markets. And a week ago, when the euro was the second worst performing currency, natural gas prices has surged. The TTF contract, the title transfer facility that measures natural gas prices for continental Europe, that surged last week, and this week to now is the price is down 35%. Brent crude hit a high earlier this week, but is now down 15% from that high, and it's down 7% on the week. So I think the first point to make in answering that question, Chris, is that the energy story, one of the key contagions and the vulnerability for the European economy, we've seen prices subside, and that I think has helped sentiment in Europe. There was a couple of factors for that. We had a statement from the United Arab Emirates calling on an increase in production from OPEC plus. We haven't had any confirmation of that, but that certainly is opening up the prospect of increased production from there. I think also, interestingly, there was a gathering this week in Houston in the United States of energy companies, and the Energy Secretary, Jennifer Granholm, was there. And the indications from there was that the Biden administration is really pushing the energy sector in the US to up shale production. That's a significant shift from the Biden administration. And if that is kind of believed and followed through on with more conviction in comments from the Biden administration, that could certainly result in increased production and production coming online faster than expected. And I think that was a factor as well. And then finally, we go from diplomacy one day to no diplomacy the next day. And the day on which we had the big energy drop this week, we did have comments from President Zelensky suggesting some compromise and some willingness to open up dialogue. And again, today we've had Putin suggesting some positive developments in terms of the potential for some dialogue going forward, although, you have to be somewhat skeptical of that. But I think that all in has helped in terms of Europe and in terms of the euro recovering and the Swedish krona indeed recovering as well. The other point this week again was the ECB yesterday. We did have a big bounce in euro, but then that retraced. We obviously have confirmation of a faster taper of quantitative easing, and that lifted the euro. But we're back below 110 now today, and I think the support we can expect from central bank policy decision making. It really is secondary to the terrible events unfolding in Ukraine and that situation. While at the margin, I would argue that the ECB's willingness to up the pace of tapering, that potentially later in the year brings forward the timing of the first rate hike, I would certainly argue is a medium-term plus for the euro. The problem yesterday was that the Governing Council appears to be quite divided. And yesterday's announcement was a compromise. President Lagarde admitted that. And clearly there are divisions within the Governing Council in terms of how to respond to this stagflation shock that's coming. Is it we need to be hawkish, we need to raise rates? Is it we need to focus on demand weakness and therefore we need to hold off on reversing stimulus? And this compromise was reached. But I think later in the year, if inflation remains elevated, I think that's the cornerstone of ECB policy, and it's their mandate. And I think ultimately that would force them to act later in the year. So medium term, I would say yesterday was a positive, but of course you can't trade medium term developments in FX at the moment. And on a turn, if suddenly natural gas prices surged or crude oil surged, the euro would get hit and sentiment would fall quite dramatically. So that really is the front and focus driver for now. But certainly the ECB development could be a positive later in the year.
Looking forward to next week, we have some additional key central bank policy meetings. What can we expect from the Fed and the Bank of England next week? And how might these meetings trigger some increased volatility?
Yeah, there's definitely potential. I guess, even though euro's back down today, as I said, we did have a spike yesterday and there was some volatility. We could certainly get that next week as well. It's a big meeting for the Fed in terms of it is the quarterly meeting when we have the summary of economic projections, which will include, of course, the GDP and inflation forecasts. We can guess quite easily what those forecasts will show in terms of another notable increase in the inflation forecast. But we'll also get the dots profile. And in December, a long time ago now, the dots profile indicated three rate hikes this year. That will definitely go up. I think it'd certainly be 4, if probably 5. 6, I think, would be a stretch. So I think 5 could be what's indicated. So that would be not quite at every meeting. There's 7 meetings left, but it would certainly be an increase from what they were indicating in December. The key, though, is that the markets looking at the Fed funds futures is pretty much priced for 7 rate hikes, a hike at every meeting. And therefore, I think the dots profile, whatever it is, I think it's going to come in less than what markets are priced for at the moment. So while it will be a meaningful shift in the dots profile, essentially the market is fully priced for what will be delivered. I think the other element of that the markets will be looking out for is the quantitative tightening, as we refer to it, and that is the plan for the Fed to start allowing maturing securities to roll off and allow the balance sheet to shrink. We may get some guidance on say, for example, the caps in terms of how much they'll allow come off the balance sheet on a monthly and quarterly basis. Powell did speak recently, though, so we have had a fairly recent communication in terms of the semi-annual testimony. And he did indicate then that we might not get the timing of when that will start, but we will get some idea on the plans. And I think ultimately, all I'll say is we should expect, the pace of quantitative tightening to be relatively conservative, because Powell has stressed that the key policy tool of the Federal Reserve will be interest rates and not balance sheet shrinkage. It is something that will go on, as he has said in the past, in the background. So assuming that that's what happens, then I don't think we're going to get too much of a policy, too much of a market reaction, because I think that's all kind of broadly in the price. And again, as I said a moment ago, ultimately it's Ukraine, it's what's happening there and what's happening in energy markets, which I think would be really important for overall FX. And then very quickly on the Bank of England. Interestingly, just to finish on the Fed, the market is priced for about 27 basis points. So pretty much, fully confident on a 25 basis points move, but not much confidence on a 50 basis point move. It's broadly similar with the UK, but I would certainly say that the risks are certainly higher from the Bank of England that they could go 50 basis points. Obviously at the last meeting, it was a 5-4 split between 25 and 50. So, the MPC is quite divided in terms of the need for a bigger rate increase. And of course, again, just like the ECB, the Bank of England are grappling with this stagflation shock and how do they respond to that? But it certainly appears from the last meeting that there's a big cohort there that are kind of more keen to raise rates quicker over the short term. So I think 25 is right. That's our kind of formal position or call for next week. But I think the last time I checked, the probability of 50 basis points was I think it was 15%, 15. So there's definitely scope there, I think, for pricing to adjust a little bit going into the meeting next Thursday. But yeah, I think if we get 25 basis points, which is what the markets are fully priced for, again, similar to the Fed, and I think the overall reaction should be quite muted, with focus still very much on Ukraine.
And then last but certainly not least, we'd love an update on your trade ideas.
Yeah, we put on a short sterling long Japanese yen, which we've just closed out of. Still in the money, so we made a paper profit, if you like, but we closed out of that just looking at the yen in general, and in particular dollar yen. We've broken above the year-to-date highs in dollar yen today, and we're just on this really long-term key resistance level at around 117. And this is a monthly intraday trend going back to 1990. So it's a very long-term trend resistance. And I think if we break here, which to be honest is looking likely, we could be in for a spurt of yen selling. And, this is in the context of obviously what's happening in Ukraine. And, traditionally the yen is a safe haven, risk off currency. But, I think the dynamics are different now, in particular in the context of rates in the US. Normally in a risk off episode with, the S&P is down about 12.5% this year. In that environment, you would expect short-term yields to be lower. But of course, short-term yields have hit a new cyclical high this week. So the inflation story is changing the dynamic to a degree in terms of how the rates markets are responding, and indeed then how dollar yen is responding. And the fact that we're at cyclical highs in short-term rates in the US is a key component for dollar yen at these levels. And indeed, our correlation analysis shows the daily percentage change on a 30-day window. The correlation between dollar yen and the 2-year yield in the US is at 0.72. And that historically is a very strong level. And it does indicate the crucial importance of that short-term rate. And, going into the Fed, when I know, as I said a moment ago, everything's priced in terms of the new DOTS profile, but the fact that they'll raise rates and confirm that there's more coming, I think it'll certainly be supportive for US yields next week. And in that sense, the yen could weaken further. And I think being long yen on a risk-off protection, it's not as clear cut in this episode as we're used to historically. And of course, then on top of that, the fact that energy prices is undermining Japan's trade position is another yen negative factor that's resulting in substantial trade deficits for Japan. So yeah, we've cut that position, and we've maintained our long dollar Turkey position. In the emerging market space, the one central bank, the one currency that stands out in terms of the vulnerability to what's going on, it's the Turkish lira, and that's of course because of the very poor economic and monetary policy management that took place in the lead up to Russia's invasion of Ukraine. And we think the lira remains vulnerable to the downside.
Thanks very much for that update, and I wish you a great weekend.
Thank you, Chris, and you as well.
Thanks, listeners.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.